Everyone's calling this like the AI bubble and the everything bubble. And when everything's high, you always get the comments from everyone saying, well, that means it's going to crash.
Toby Newbatt is a personal finance YouTuber and friend of the podcast.
But I think the really, really important question is always, okay, knowing all of this or guessing all of this, what should you do as just an everyday investor? And I always think it comes back to the basics.
Welcome back, Toby. Thanks for joining us again. We got Toby Newbatt, host of Toby Newbatt YouTube channel, visiting us for the third time.
Second time. Don't preempt too much.
Sorry, I'm putting it out there.
If you keep coming to Manchester, I'll keep coming back though.
Awesome. Yeah.
AKA Mummy Pig, Daddy Pig, and I guess that makes me Peppa Pig.
AKA Tubbs. I call him Tubbs.
Tubbs, yeah.
AKA Tony.
Tony, I get called
Tony
that a lot.
Newbatt.
B&N on the keyboard.
I get Daniel all the
other.
time. Nice channel. Love your work, Daniel.
Like,
what?
And I just keep it going. I'll pass my thanks on to Tony.
Yeah.
just see how long it keeps going for. I always enjoy that.
Yeah.
Or some people, if they're watching both of our videos in a row, someone will say on my channel, oh, that was a good video, Damien, because they must have watched your video first, then watched mine, but they've commented later on, and it's come up in my video, or vice versa.
Okay. Well, we're not going to talk about YouTube today, mate, because that's what happens.
Otherwise, too much.
We're going to talk about the stock market being overvalued.
Juicy topic. Juicy topic. Shall we make the bear case first? Should we be really bad about it and go down the negative side?
Let's talk about why are people worried about this? Why are people asking this question right now, do you think?
So it's weird because we're in this, everyone's calling this like the AI bubble and the everything bubble again. So it feels a bit like 2021 again. So you've got not only the stock market, like the S&P 500 up at all-time highs, you've got other assets as well. Bitcoin, over 125K, at least not right now, but it was over 125K.
11K right now.
At the time of
I didn't check just before we filmed, no.
As we record, it's like dropping by $1,000 every minute. You've got
How's that feel,
gold
mate?
as well. Silver, randomly, as well, another commodity making an all-time high.
The London Stock Exchange.
The London Stock Exchange
it's a
having
bubble
really
when
good
that's
year.
up.
So it's a bit of a weird one where everything's really high. And when everything's high, you always get the comments from everyone saying, well, that means it's going to crash soon or it has to go down. You've also got the concentration risk as well, which is another thing going on at the moment. So much of the world's wealth is in just a few big tech stocks. So the likes of Nvidia, Microsoft, Apple, and so on. I mean, the top 10 S&P 500 stocks are now making up 38% of the entire weight. So I believe that's nearly higher than it's ever been before. So you think if one of those fail, then that's going to have a big impact on people's money. So
they're also interconnected as well.
They are.
Like literally, they're passing money around each other.
That's
it
right.
Almost feels like market manipulation, doesn't it?
It's weird, yeah. I know Sashi did a good video on this one recently about companies investing each other and saying, well, I'll invest $1 billion into you if you buy $1 billion worth of my services. So lots of these things are coming out at the moment.
But it's 100 billion, isn't it?
But it's 100 billion, which is a huge amount of money.
I mean, to explain, like Nvidia will be ChatGPT, OpenAI buy chips off Nvidia, but they don't have the money to do that.
Correct.
So, but then, Nvidia will invest in OpenAI, who then invest in take money from Oracle, who then buy. It's like this cycle of money that's flowing. So it's a bit
weird at the moment, because you've got all this money flowing into basically anything which has to do with AI, which I think most of us will probably agree is the future in some way. But we don't know how much money is going to take to actually generate some new profits, new money. So loads of people are worried that the stock market is in a bubble or overvalued. But the difficult thing, I think the biggest question is, okay, well, what do you do about it?
Yeah. And I think in terms of, you say there that we might agree that AI is the future. The problem is that the market's forward price.
Yeah.
And they have essentially priced in that AI is going to be the future.
For sure.
And it's whether they deliver on that promise.
Correct.
And I think when people buy the stock market, what they don't anticipate is that they're forward looking. So you're already buying the assumptions of price and profits of tomorrow.
That's right.
For the price to go up, essentially those companies need to deliver more news that says, actually, it's going to be even better than that.
Yeah.
I think people buying the AI narrative now probably don't realize that we've priced to perfection in a sense.
That's right. And that's the funny, that's why this stock market investing is so difficult to get your head around, is because the price of the stock market is the price of basically all the future cash flows of the companies that are in the stock market.
The expected cash flows, yeah.
We don't know the future. So basically, it's just the best guess that everyone's got. The short-term traders, long-term investors, people like us, some people who don't even care about what they're investing in. It's all just a big guess of what the price might be. And with the price being so high, relatively, no wonder people are scared. But there's so many different stats that you can basically pull out about suggesting why the stock market might be overvalued, or actually, on the flip side, I can also pull out some
why it's not overvalued.
Good stats to suggest that it's a great time to invest as well.
Let's look at the Schiller Cape as a starting point, because this is the big one, right?
Yeah.
I mean, my buzzer. Sorry.
So,
Far away buzzer. Schiller Cape, we've definitely discussed it before, but it just sounds like...
Robert Schiller.
So it's a mystical cape that you take out with you when you want to invest.
When you want to
shill some crypto, shill some stocks.
Yeah.
What's the Schiller
So
Cape?
I always call this the final boss of investing. So it's a chart that gets wheeled out by people to make some sort of suggestions about why the stock market be overvalued. So cyclically adjusted price to earnings ratio. So basically, and it's based on the last 10 years as well. So really basically a price to earnings ratio on any investment. If a company makes $1 billion in profit and the PE ratio is 10, then it's a $10 billion company effectively, right? So generally speaking, higher PE ratios signify a company being more expensive and a lower one is cheaper. Now, higher PE ratios might be given to companies like the big tech companies at the moment, so Nvidia, Amazon, etc., because they're also growing fast. But generally, the long-term average of the stock market has been about 16 or 17 if you go back all the way to 1900. So at the moment, the Schiller Cape is really high. It's not the highest it's ever been, but it's very close to being near all-time highs. And the fear is that the times that it has peaked before have been before like the dot-com bubble and around the global financial crash. So people are kind of suggesting that this chart, therefore, because it's high, a crash must be coming. Now, I think that's a really dangerous thing to come out with, but lots of other people are definitely adamant that things are going to go bad and they'll sell everything and buy gold or do whatever else they want to do.
But gold is also at all-time highs.
But gold's also at all-time highs.
And if you're expecting gold to double now, it could do, but it's very, very it's not going to happen anytime soon because it's already so high, but people are still buying it.
Everyone, exactly. There's been quite a few stories in the news about gold. Institutional investors wanted to buy gold. There's so much demand for it that there's two different standards of gold. The gold bars in the UK and the gold bars in the US as well. I forget the exact differences, but gold comes from the UK, gets moved to Switzerland, I think, processed and shipped over to the US. But there's so much demand.
Like different size bars or something.
Yeah, I forget the exact measurements.
Or something.
Yeah,
ours are bigger.
Yeah,
ours are bigger.
Ours are chunkier.
Heavier, bigger.
If we've got any left.
Better on a night out.
Yeah, but it is weird because you're right. So basically, if the stock market was low, you'd expect like gold to be high because gold is typically a flight to safety. People buy that because you can't really make much more of it and you can't define much more of it. So gold tends to be stable. But at the moment, you've got stocks at all-time highs plus gold. Now silver's catching up randomly and even Bitcoin as well. So we're in a very weird time at the moment. I'm almost like, what do you even...
It's kind of like there's the AI narrative and then there's the debasement of currency. So it's like the dollars are getting printed into oblivion. At the same time, there's a lot of optimism about AI. So you've got these two kind of factors. The the cash narrative of the last, say, 10 years is pushing people into assets to try and outrun the kind of inflation.
Because what's the alternative? It all comes back down to basically, let's say if you are not investing at the moment and you wanted to start getting invested, well, every minute that goes by, your money's getting eroded by inflation. So you have to do something with your money. And I can totally understand if you're a beginner investor right now, the confusion and the stress. Because someone in my comment section on a recent video was like, they just started investing just before we had this China threat tariff by Trump. He literally invested the day before and he's like all optimistic. Yeah, the stock market's doing great. And then he sees his investment tank almost 10%. He's like, how can this happen to me? But the comment really ended by saying you have to stick with this thing for the long term because these short-term moves are totally irrelevant if you're a long-term investor. I think that's what might come back to on this video. But when you try and value the stock market, in my opinion at least, it all depends what you want out of it as an investor. If you're a short-term trader, great, you're loving life because you can mess around with all the things happening in the news. But if you're a long-term investor, my view always comes back down to the fact that it shouldn't really matter. It's easier said than done.
It's interesting to me because I think when people go, is the stock market overvalued? What they're really asking is it about to crash?
Yeah.
And I think you kind of need to assess that, like the root cause of that concern, because by the stock market being the highest price it's ever been, what it's essentially done is worked. Like it's worked for you. Anyone who's bought it ever right now nominally has more money than they started with. So everyone is now like, oh crap, but like it worked. What do I do?
Yeah.
You know, I downloaded. I just looked at the market returns of the past few years, starting in 2019. 28%. So this is the S&P 500,
Yeah.
which is broadly, you know, the global stock market really. 28%, 16% in 2020, 26% in 2021, 19% 2022. Minus 19%, minus 19%. Yeah, minus 19%. Then it went 24, 23, 14.
Yeah.
I think the average over that period is about 16%.
Yeah.
So the long-term average of the American stock market, closer to 10.
Correct, yeah.
So we've had this period of exceptional growth.
Yeah.
So actually, we're probably due some poorer returns or a correction because, you know, for people that have ridden that over that time period, they're doing better than the long-term average.
Absolutely, yeah, no, for sure. It's a weird thing, isn't it? Because we, as investors, we never know what we're going to get in the future. We could be investing through the best 40-year time horizon that we've ever seen, or we could be going into the worst, but that's one thing we can't control. But at the moment, certainly a long-term average of stock market returns have been around 10%, and we're sat here now on 14%. Absolutely, over the longer term, you would expect your returns to be shorter. Now, or to be less, I should say. However, trying to guess when those are going to happen, that's the bit which gets a lot of people in trouble. For example, you might say, I looked at some of the stats on this one actually as well. 80% of the time after a kind of a bull market run in any given year, 80% of the time, the next year is also higher.
Yeah.
So it's not one of the things where just because you have a really good year, the next year has to be a bad one, or vice versa. If you have a really bad year, the next year has to be a really good one. If it was that easy, we'd all do it.
It's that Mr. 10 Best days thing.
Exactly.
And they typically are in the worst.
You just don't know these things are going to happen. I mean, likewise, what we've just seen in the last few days, we've had basically the US and China having a little spat about potential tariffs, and that sent the market into absolute turmoil, both up and down. I mean, how do you trade around that? How do you predict that? And I would argue that you should personally.
I completely ignored it. I only knew about it because other people around me talking about it, because I'm focused on prepping for the podcast and getting on with my life.
I think most people really should be focused on just
doing their day jobs,
getting on with it. Exactly. And that's such a difficult thing, because I think the real question when people are asking about whether the stock market is overvalued, I think it comes back to this age-old question of, is this a good time to start investing, or is this a good time to invest? My answer will always be yes.
Yes. Yeah.
As long as you're a long-term investor and you're broadly diversified, using the right things, all these boring things, which are boring to us because we talk about them all the time, but actually are most people still don't understand what they mean.
Last time we recorded, Tamain, you were having some real dramas with your accountant. So how's that been going, mate?
They're sacked. So drama sorted. They're a big corporate firm. They didn't really reply to my emails very quickly, like took a week or two at times. And they charged me way too much. I mean, I've got pretty simple taxes, and they were charging me thousands. They saved me some money, but I had to move on.
Slow and expensive.
Pretty much, yeah.
This is one of the reasons that we're really happy to be partnering with TaxZap.
It's a tech platform that makes self-assessment simple. Whether you're self-employed like me, a freelancer, or a director like Damo, big dog.
Instead of sending endless emails, bills and spreadsheets to your accountant, you just connect your bank, answer a few questions that are only relevant to you, and your tax return can be ready in as little as 15 minutes.
TaxZap is really easy to use, and it's HMRC recognized software, so it's safe, secure, and legit.
The price is also decent. So if you're self-employed with one income stream, it's just £89 as a one-off fee. No big accountancy fees. And we also have a discount code, of course.
If you need to file a self-assessment this year, give TaxZap a try. We've left a link in the description, and use the code MONEY10 for 10% off your first tax filing.
I've got some trivia for both of you actually as well. I was looking into more things about the stock market being overvalued and how these concentrations change. So just 20 years ago, right, the top 10 stocks in the S&P 500, so 2005, there's only one company who is still in the top 10 now.
I think I know who that is.
Out of all of them, okay?
Of course you do, you know everything.
So top 10 now, you've got, I think in the right order, you've got Nvidia, Microsoft, Apple, you have Broadcom, both of Alphabet's, you have Meta, I think you may have Tesla or Berkshire Hathaway. So out of all of those 10,
I know which.
If I've got all 10
you
right.
You can say one.
Which one?
Which one is it?
Was also featured in the top 10 of 2005, just 20 years ago.
So 2005 is an interesting period because it's post.com, so that might be the curveball.
Maybe.
Because I know the one business that's like
I would say
dominated throughout quite a long period of time.
I would say Microsoft or Berkshire Hathaway.
Microsoft, I think.
You're going to go Microsoft. You're going to go
but I think the 2005 is the curveball because this is post.com bubble. Who else? It wasn't Tesla. It wasn't Nvidia. Berkshire Hathaway. I think it's probably Microsoft.
Microsoft or Berkshire? I'll say Berkshire. Actually, 'cause you said
Microsoft.
It was Microsoft.
Damn it, I always
It
said
was
that first.
Microsoft.
They were probably-
weren't number one though. They weren't number one. I think they were like 5
I
or
think
6.
in the 95 they were there as well.
Yeah.
They're like the one company that's consistently...
They've been quite persistent. But
Yeah.
yeah, I know both me and Damien have done this in our videos, but it's so interesting when you go back, if you're talking about like stock market concentration, of just how quick things change in the stock market.
I mean, it was Raycon, like all these weapons companies
Yeah,
just 10
Raytheon
years
and all these other
before. And
ones.
yeah, it's constantly changing who the big guys are.
Yeah, because on this topic of stock market concentration, again, I looked into this a bit more in depth. It's like, who's to say that stock market concentration is necessarily a bad thing? So at the moment, although it is higher than it's ever been, especially when you look at the top 10, so it's like 38% of the S&P 500 is in just 10 stocks. Again, to someone starting out, you might think, oh God, is that bad? Is that high? Well, actually, why? I don't know. It's high because these companies are actually making more profit than they've ever done before. And therefore, you would expect more of your money to go there. It's a little bit of a bit inevitable because it's almost like how capitalism works. It's like winner takes all.
Yeah.
You start off with 10 technology companies, 8 of them die because they're rubbish, and the 2 that survive basically.
It's also broadly why you buy the index, because Hendrik
exactly.
Bessenbinder says that most companies will deliver no returns.
Correct, yeah.
So you can't find the needle in the haystack, to
No,
quote Jack
you buy
Bogle.
everything.
So you buy everything because there's a handful of companies that will deliver the majority of the returns.
Exactly. Because going back to the topic of AI, so I think most people are in agreement that AI, robotics, automation, these topics are probably the future. Just like cars were the future a long, long time ago, and the internet was the future. But we still had the dot-com bubble, and more car companies have gone bust than you will even believe. You can Google this, but there's thousands that have gone bust. But the car was the future. So although AI probably is the future, we still don't know the winners.
Yeah.
And although we might guess and think, oh, well, surely it has to be Nvidia, or it has to be Apple, or it has to be Meta. Well, it doesn't have to be anyone.
Yeah.
It could be a company which today is not even started up in someone's garage down the road.
Like when we thought Ask Jeeves was the one, and then Google popped up and they're like, no, who's Ask Jeeves?
Exactly.
Yeah, so
Yeah.
it could be like
Ask
Nvidia
Jeeves.
latest, mate. We're the new Nvidia.
Yeah. Yahoo was huge for a time. I forget what the story Yahoo. Someone bought Yahoo at its top. I forget which company bought it, but that just faded out of nowhere. For a lot of people, that was, oh my God, Yahoo, that's the company to own. And you had the Nifty 50 many decades ago as well, all these .com companies. And although some survived, the vast majority of them don't. And I personally think that technology is going to make this cycle faster and faster. I think the companies are probably going to change.
I find that greatly reassuring that the companies at the top continually churn, continually get outrun, and markets have delivered positive returns to investors.
Yeah.
I think people look at that and worry,
Yeah.
but I see that as like really affirming in terms of what we do.
I think that's what you want the market to do, really, don't you? You want the new companies, because as companies get bigger, although they have a lot of cash, and in theory they can sometimes buy a lot of their competition, they can buy all these companies.
That is a worry that they become so big that
Now
no one can
that
replace
could
them.
be, yes. If we go down the bear case again, we could argue now that they could stifle innovation.
But this is a Standard Oil thing. This
Yeah.
is where the regulators, they come in and break the companies up, basically.
That's it.
That's like when they're anti-competitive.
But have we had it before like this when companies are so
Standard
big that
Oil.
they're making more than like a country?
Rockefeller. Yeah, every basically oil company on the planet traces its roots back to that one man. It's crazy. Exxon and Esso and BP, they were all just his. Was it Standard Oil?
I forget the exact names. But
JD
yeah.
Rockefeller. He was so big.
Yeah.
He like just bought every oil company and monopolized it. So
Yeah.
they came in, they broke it up.
So you've got to, so at some point we may need more regulation, but then also you've got governments trying to fight for control of their stock markets as well. So it's a really, really interesting thing. But I still think kind of maybe optimistically that, we'll see new blood in the stock market. I mean, even if you think really recently, how long was Apple at the top of the stock market for? A long, long, long time. At least it felt that way. And they're now third.
Yeah, and like many people would look at Apple and go, the shine has kind of worn off them a little bit, like their products. And it's funny, isn't it, that because 5-10 years ago, people were like, oh, never bet against Apple.
Yeah.
Apple are going to dominate. We'll all be wearing Apple microchips in our heads and all this kind of stuff.
And they still could. The thing is, though, so they still make an absolute fortune.
Yeah.
It's just now how much more like
got an
growth
Apple
is priced
iPad
in, and how
there.
much they're just not thinking. So yes, say that, but we've all got Apple products on us. Basically, they own most of the market share of the.
I was about to say I'm the only one in the room without an Apple product because I got
Yeah.
Samsung, and then Damon's like, you got an iPad in your hand.
Yeah.
Yeah, no, you got an iPhone
Damn.
in your hand.
I want to come back to this point around crashes because I think it's really interesting because I like what I want the listener to do is challenge their narratives around them because, I think we all think, oh God, we're about to have the worst crash ever.
Yeah.
What we don't realize is like, so I asked ChatGPT, because, you know, AI is the future. I spoke about the returns for the average of 16% over like 6 years.
Yeah.
What could returns look like to get us back to that average return? So this is like a reversion to the mean.
Sure, yeah.
So what could we get as a sequence of returns to get us back to about 9-10%? -5, then 2, 4, 3, 5.
Yeah.
So if we had that sequence of returns over the next 6 years, 5 years, we would get back to an average return over the period of 10%. None of those is a crash.
No.
-5 is not a crash.
No, it's true.
And, you know, yes, they're not great returns, and they might even be negative when you adjust for inflation, but it's certainly not the market dips 30% and the world burns, which I think is what most people are talking about.
Yeah, I think we've got this natural tendency to think negatively,
like.
to go really bad. It has to be, and those are the headlines that grab the attention. No one cares. Stock market might do 1% next year. That's a headline in a video that's not going to do very well on YouTube. So it's always got to be, this is coming next.
It
This
could be
is
a
really
lot more
bad.
muted. And after a period of lower returns, the expected return actually goes up.
It does, yeah. Generally, again, and when you look at this data, it's really interesting, but it's also you should be really careful how you use it moving forward, because obviously none of us know. But it is really interesting, generally speaking, when going back to that Shiller Cape ratio, when the PE ratio of the stock market is high, expected returns have been lower. But it's not always the case. So you will find years where the stock market returned a lot, but it also will return a lot the next year and the next year. But it does get people worried. And then, of course, like with anything, if we all believe the stock market's going to crash and we all stop investing, well, we can all make it happen.
We can make it
That's
happen.
why I want the
theory.
IMF and Andrew Bailey to shut up.
Yeah.
Because I'm like, are you trying to make
Are
it
you trying
crash?
to make it crash?
Everyone's like, there's a crash coming. I'm like, only if you say so.
Yeah.
If everyone was like, no, this gravy train's keep on going,
Yeah.
it might not happen.
It's so funny, isn't it? But I mean, the thing that maybe would cause a market crash, probably none of us can even see coming anyway.
No, some
if
black
it was
swan
obvious.
event.
Yeah, black swan event. Like you said about trying to challenge yourself as an investor, just if you're new to investing, you have to challenge yourself to realize that none of us know anything really when it comes to the future. We can't even predict what the temperature is going to be accurately tomorrow, let alone what it's going to be next week, next year. I mean, and then when it comes to the stock market, good luck. Good luck trying to predict anything from returns of a company to interest rates, to inflation, to GDP, to growth. I always laugh when I see the big the big institutions predict, growth in the UK is going to be 2% next year and then 3% the year after, and then it's going to steady down to 4%.
Oh, sure,
Will
buddy.
it?
And all of those, they're always wrong. Go look at the OBR
Does anyone
reports.
go back and actually
I do.
check?
Go back through them, and they're always wrong. They're always redrawing the line.
Yeah, they're always
this is where
redrawing
we
it.
thought it'd be now. But when you trace it over time, it's like miles apart.
It doesn't. So I almost think it's almost pointless. It's almost pointless trying to predict. I know it's very tempting. The temptation is because we go back in the past and we look at all this amazing data. It's really easy to go back and explain, the stock market did this because of X, the stock market did this because of Y, and it crashed because of Y. Therefore, in the future, if we avoid these things, we can do that.
Doesn't work like
but
that.
it doesn't work like that. But it's so tempting to. I think it was a great quote. It's like the ease at which we explain the past makes us fall into a trap of being able to predict the future or something like that.
Yeah. And again, the psychology of a new investor should be, I want to crash, because if higher
sure.
valuations today lead to poor expected returns, if the market crashes and you start investing, then you've got higher expected returns going forwards. You want to buy those burgers for half price.
It's funny, and going back to psychology as well, everyone says, I can't wait for a market crash and I can't wait for the buy stock cheaper.
And then they
don't. Yeah. When it comes, they won't
the
buy.
market's crashing because people are dumping.
Yeah, people are dumping because they're scared.
More sellers than buyers.
Both of us will remember 2022 through our videos and stuff, and the comments that you get. You do notice people being a lot more bearish, like, it's a lot more to come now.
Are you going to talk about the recent drop?
The recent drop.
I get that all the time.
I think I also remember at the end of each year, I tend to do a video about getting people to predict what they think is going to happen. And I also remember going into 2025 or 2024, it's one of the years so far, and everyone was like, guaranteed recession, gonna drop 30%, I'm all out. And nothing happened. What have we had for the last 2 years? Almost like a crazy, insane bull run. Whether it's justified or not, I don't know. But I do know the danger of trying to predict it is just something that a lot of people are going to fall into.
People really struggle with the idea that the economy is not a good predictor of the stock market in the short term, especially. And people think they get really clever, listen to economists, and then go, it's going to crash. Yeah, but it's not like that. It's just, it isn't.
Do you think it's because there's so much emotion in in the stock market?
I think it's billions, trillions of individual inputs all over the world. Like, people think of the market, and the market was like labeled as such because it was interesting for papers to report on it in the past. They developed an index so that they could go, this is the market, because they wanted to talk about stuff every day. What the market actually is plane companies, weapons companies, drinks manufacturers, blah, blah, blah. Diageo has a bad day, and you see that reflected in your global portfolio in the market. You don't even know why, but they might have just had like a factory closure or something. So for me to say I can predict the market, I'm predicting the outcomes of billions of inputs, like across multiple sectors. Like, it's impossible. So that's why, because, you know, like, people get attached to sweeping narratives. They don't realize the complexity of the market. It's the aggregated intelligence of every activity and input of the whole human race.
And we're trying to predict different
You go outside and try and predict what 5 people do in front of you. Go like, guess. You're not going to do it.
Try and predict what you want to eat for dinner, and then
all of it.
everything on the menu.
The whole world.
In fact, you did a video, I think it was a couple of years ago. Do you remember that Darren Brown experiment about betting on the horse racing? It's fascinating, that one. It would basically get the fact that if you get enough people to predict an outcome of something, you will get one person who'll get like 50 things right in a row. That doesn't mean they're a genius. It just means statistically you're going to find someone. And this is a great topic in investing as well, when we come back to, because we talk about the market and we talk about trying to beat the market. Now, there will be people, and there are people who do beat the market consistently and have beaten it for years. The likes of Warren Buffett with Berkshire Hathaway. You had the likes of John Templeton. You had other popular famous investors. Now, that's all well and good. Who's going to beat the market moving forward? I mean, I don't know. Other people may suggest, well, you just go with the people that have beaten before. They've got a good track record. But I personally think that's
Warren Buffett could literally be the guy with the winning horses. He could be the guy, you know, you line up a 20,000 people, get them all to predict stocks. You get one at the end, and would you hold him up as going, he's the messiah? Or would you go, he's the guy that just... He's the only one, which actually proves that it's, you know, statistically really hard.
Because also it's so difficult. So although his track record is really good and, you know, unmatched by almost everyone, it's really, really difficult to then suggest that he can do that just basically moving forward. And also, not every pick has worked out correct as well. He's made plenty of mistakes too. It's just the winners, of course, when you have big winners, have made the huge difference to the portfolio. It's such an interesting topic, and I think the reason people will keep trying to beat the market though is because there's so much at stake. Well, if you get it right,
the reason Warren is so rich is because the rewards for doing something are massive, and the rewards are so massive because the risk is so high. Because risk and reward correlates perfectly in that sense. Why is he worth hundreds of billions? Because he did one of the riskiest things on the planet and won. You know,
basically,
If you want to try and replicate that, you've got to understand that the chances of you doing it are very low, because there's no easy way to earn 100 billion quid.
That's it. Yeah, I try and think about investing. I try and compare it to something else, but I think it's quite difficult. I always try and think about is finding a good investor like trying to predict a good footballer, or, you know, like Pop Idol or something, or trying to find the next hot person. It's like, I bet for every...
I think it's like maybe like musicians. There's so many talented people that on face value, if you sat there and listened to them for half an hour, you'd be like, yeah, they've got it. But it's so random.
So few make it.
And it's luck and opportunity and a few things. It's like... I think the musical world is full of talented people.
Exactly.
Most of them are
there's
nothing.
loads. We've obviously got more than ever. It's like, and it's like footballers. There'll be so many people up and down the country who will go and play.
There's probably a Messi in Brazil that never got
there's probably a
spotted
Messi out there right now. But unless they get the luck and the break to get into a team, their potential is never realised. But then you also think, okay, then I'm trying to think, is that not a good way of looking at it? Because let's say you get like David Beckham, for example, you know, how many times he was out there practicing curling the ball into the back of the net. How much of that is then skill on the day, or does he get a bit of luck as well on the day as well? How much goes into it? But that's trying to predict who's going to have good stock picks in the future, I think, is so difficult. But we still do it, because I still have a few, you know, still play around.
For Warren Buffett, Berkshire Hathaway, they've got they're sitting on a large amount of cash currently.
Correct.
I love this.
And I hear that, like, I hear it from...
So that means you should have all your cash.
Does that mean we should therefore have loads of cash because there's a crash?
I was going to ask this question.
And like loads of, like, you always hear, like, when these big investors or big JP Morgan does this, people are, oh, they've done this, so therefore it means that we should do this and we should follow them. Like, is there any correlation, or it could be...
Well, personally, I'd always say no, you should never follow other people, because they're not in the same situation as you are. And actually, on this specific topic, Warren Buffett has made it very clear that he wanted to have a large cash pile specifically for basically his successor to be able to have a bit more free reign. So that was a specific reason for that one. Yeah, and this
but
comes
he
up
said
all the
that. Do
time.
you know if that's true?
Yeah,
He could just say that, and
true,
then the market
true.
crashes. He's like, "Hey, got him."
Yeah.
But there's also this like, they operate at a scale that is unimaginable to
Yeah.
you. Don't compare your 300 quid a month to his 300 billion.
It's true, yeah.
Like, try spending that. Try spending
It's
that in the
not
market.
easy.
Go find a company
Yeah.
that's worth 300 billion that's undervalued, because companies of that scale are so closely monitored that it's really hard to find opportunities. This is one issue that Warren has that you alluded to. He's so big that effectively he can't buy anything because
Yeah.
he can't buy 300 companies at $1 billion each. It would take too much time for him to research them. He needs huge deals, but they're really hard to find at that level. So I think it's really interesting that people would mimic their behavior off someone who lives on a different universe to them, basically. And that's what they're doing.
Yeah.
It's tempting though. Again, it comes back to this, that because we feel like we can explain the past really easily because we can look at all the data. It's like like an F1 race or just anything like that. Or you can go back on a tennis match. You can look at all the statistics and go, and then try and basically guess the future from that. But in investing, you absolutely can't, because there's just so many things that are unknown, which then comes back to the fact that should you even bother trying to time the market, or should you buy individual stocks? Well, I don't know, it's a tough one because it comes back to emotions, because saying all of this out loud, I know all of us in this room will still have our own little investments on the side or different things and individual stocks.
Okay, T, talk to me about your attitudes towards risk.
I mean, I like a bit of risk in my investments, but I definitely would say since the podcast, I've toned it down a little bit, not quite as gung-ho and like carefree as I was in risk. So yeah.
Yeah, shooting from the hip all the time, weren't you? Yeah. I think personally that you should take risks, but it should always be in areas where you have a unique skill set, an edge, expertise, like your job, things like this.
Definitely.
One area that I wouldn't take any risks is compliance.
Yeah, the risk changes as you grow in business, and you need to be on top of it, which is why we partner with Vanta.
Vanta automates a lot of risk processes and helps you see your risks in a centralized platform so you know what really needs your attention.
Besides risk, the main thing Vanta does is automate compliance with security protocols you need to scale, like GDPR, HIPAA, ISO 27001, and SOC 2.
The beauty of Vanta is they make it easy to prove you're compliant with these standards, saving you up to 90% of the time it takes. And on average, $500,000.
If you know what these acronyms like SOC 2 are, you probably need Vanta. You can book in a demo at vanta.com/making money. There's a link in the description.
Well, I trade. And
yeah.
I tell everyone I love to buy a dip, but on Friday I bought some crypto. I had a trade open. Trump said something about China. The whole thing got liquidated.
Yeah.
And then I was like, wow. And I was like, well, it is a dip. I could buy it, but I was so stressed.
Could you predict that?
And so,
Could you predict that?
Of course not.
Exactly.
But I was so shocked that it took me about 12 hours. I
Yeah.
didn't buy the dip till the next day, and obviously it come back a bit. But I always say, yeah, buy a dip is a great price, but I was like, I can't believe it dumped so hard. What's going to happen? Maybe it's going to go to zero.
Yeah, it makes-
I knew it wouldn't, but I was like, maybe it is. And
That's
then
it.
This is
the
why I
next
don't
day
have
I calm myself. I'm like, buy the dip. It's a good time to buy. But
Yeah.
it's still for me,
It's
who
still
always
so
tells people
difficult,
it's hard to control your emotions in that moment.
And there's also times where the dip doesn't come back. You get a lost decade and it's 10
Yeah.
years and you bought in. I don't buy any individual companies anymore. Sold them all. I used to as of 12 months ago. But what I realized was the headspace, the worrying.
it takes a lot off.
Yeah, I'd rather not. I can earn way more money by just being focused on the activities that I
Yeah.
do day to day. So yeah, I got rid of it all. I literally just own a global index now.
Yeah.
I own money market funds as well.
Yeah,
Trying to think if there's anything else. Bit of Bitcoin, but that's it. Yeah.
Easy life.
Easy life, mate.
That's a good. I'll tell you what about market timing though, T. One person did make over, I think it's about $200 million shorting Bitcoin just at the right time.
Someone might say that's
maybe
insider
they
trading.
predicted something. Who knows?
Maybe it's Trump's son. Who knows? But yeah, it was the last trade they made was 8:59. Then he
Yeah.
tweeted at 9 a.m.
Yeah.
and then they made like 2 minutes. I think it's a little bit
That's some of the
convenient.
heaviest shorts ever seen. into
Heaviest
Bitcoin.
short I've ever seen. Yeah.
It's outrageous. isn't it?
Outrageous.
It's
Yeah.
outrageous.
Can't keep getting away with this.
Let's. There's one argument that the market will keep going up because Trump will just make it.
Yeah.
Because his whole image rests on that market going up,
Yeah, for
right?
sure,
So,
definitely.
as long as he's alive, we're probably all right. I wanted to talk about the reasons that it might continue going up now then. Let's look at the individual businesses a little bit or the profits that exist within them. One thing I see all the time is it's the new dot-com bubble or it's going to be the 2008 crash. I looked at the details around the 08 crash, 07, 08. the scale of the money was so much bigger then, because what had happened was you had like $1 trillion of mortgage lending
Yeah.
to basically people who couldn't buy,
Yeah.
that couldn't pay for their houses. And then we had these like derivative products on top, which bet on top of that mortgage market. So it was multiple trillions, 8, 10 trillion.
Yeah.
The money today is a lot, but it's not to that scale. And also it's not reliant on individuals who are not going to pay their mortgages. It's basically massive companies spending their cash reserves.
Yeah.
So you can't really draw a line between the two. Maybe the dot-com bubble, but what does the profit of these businesses say at the minute? Where are their cash flows?
At the moment, and it's when I did my last video into this and looked into the latest data on this, I think JP Morgan do this really good reports every month, or I forget, I think it's monthly or quarterly. But basically, at the moment, we're in this weird space where stocks are highly valued, but also their earnings, their profits have never been higher. So
They're backing it up.
they
almost.
are backing it up with the money at the moment. There'll always be a question of how much do you pay for those profits? And again, we go back to these PE ratios. For every £100 you put into the stock market, if you only get back £1, that's not a very good investment. And there's only so how long you want to keep paying for that. So at some point you could say it's too high. But then again, it comes all down to basically how much in the future do you think these companies are going to earn? Lots of people are very, very confident that they're going to make a lot of money, and they could do. They very well could do. This all comes. I think this really then all comes down to the market. I think the market at any time is basically everyone's best guess of what we think it's going to be. The bears and the bulls of people who think it's bad, people who think it's good. This is the price. But generally, so far, it's a weird. Trying to compare today with the likes of the global financial crash and the dot-com bubble, I think it's a bit difficult.
I mean, in the dot-com bubble, the companies weren't really making revenue.
That's the
like,
thing.
So like
Yeah, lots of
Pets.com
speculation,
and all this
exactly. Brand new
speculation didn't actually
companies.
have earnings, whereas Nvidia have a lot of earnings and all
Nvidia
these
has
companies
huge
have.
earnings.
So does that indicate that we might not be at the crash or at the top of the bubble because we've got a long way to go because they're actually making earnings, whereas .com they actually weren't generating.
For sure,
them.
definitely, yeah. I think it's a good narrative. I think there's you can make a strong argument that you could make an argument that we might be inside of a start of a bubble, but you can make an argument that we're nowhere near the end of it.
Yeah.
And until prices get so extreme that there's no connection there. The popular saying is that the stock market in the short term is a voting machine. In the long term, it's a weighing machine, meaning that really it's all about the power of a company in the long term and the actual earnings of the company. But in the short term, people can do crazy things. But certainly at the moment, it's really hard to point to the super negative stuff. If we look back, for example, I guess the nearest thing in our memory is probably 2021 when you had NFTs and Pokemon cards going through the roof. That's when you probably should have stepped back and thought, this Spider-Man NFT is probably not worth $100,000, is it really? You know, and
millions for little apes and things.
For little things like that. But now I think it's really difficult. It's such a difficult question because everything is up at prices that we've not seen before. Yet you've also got inflation still running quite relatively high as well. It's a really difficult question. I could make a strong argument either way. But I think the really, really important question is always, okay, knowing all of this or guessing all of this, what should you do as just an everyday investor with this information? And I always think it comes back to the basics of just basically, you shouldn't react to this information. If you're brand new starting out right now, in my view, you should just start. Waiting is going to, like Damien says, going to take up so much headspace and cause you so much stress. Just get started. And even if the crash happens tomorrow because you put your money and you think it's the worst thing ever, that's not going to be the only time you ever invest in your life.
The next month you buy in the dip.
You're going to do it again.
And the next month. And it's like, just don't invest every penny you're ever going to invest on day one.
No.
Just start gradually buying into the market.
Because that's what most of us do anyway. Even if, it's funny, there'll be lots of people watching who probably don't necessarily actively invest and choose to invest, but most people who are watching this will be employed and will have a pension effectively every single month out of their paycheck. They're putting money into generally the global stock market and some bonds. So they're doing it every single month without even thinking about it. Now, if they can do that in their normal lives, I think most people would be pretty good. But it's hard to know. No one knows.
Like one thing that I wonder, so you're talking about the companies and you're saying, the companies, the big hitters are making money, right? I wonder like how much of the private equity and VC is taking that hit in terms of buying absolute dross businesses. Because in the past, the playbook was get pets.com, get a domain, let's take you to IPO and let's dump you on the market.
Yeah.
We've seen in the last 10, 20 years that companies come to the market much later because they can raise finance through VC and private equity. And I'm wondering, are those the people that are buying? Do you know what I mean? Like,
Yeah, mate,
is it all
it's
trapped
quite-
there? Because there is definitely... We've got these big companies, but there's definitely a load of companies at the minute that are just coming to the market that I see that are just like, oh, we are the AI of whatever.
Yeah.
Stick AI in it.
You've
You
got to
saw
stick
it when
AI
you were
in it.
working for that
When I
company.
was, working in venture capital, yeah.
If you
everyone
didn't
was
have
just
AI
gonna-
in the name, you weren't getting money,
like,
right?
we're a glass company. AI glasses
Yeah.
we make. It's like, why are your glasses AI? They just we just put AI in it. No connection. They just knew that we'd get them invested.
So that's bubbly. That's like speculative territory.
Oh, 100%.
Right?
Yeah, I think you can make the case there. One interesting thing, though, if you go back to the IPOs, I was looking at the stats, and this year so far isn't really a particularly great year for IPOs. It's been fairly standard. 2021 was the crazy year where there was like over 1,000
SPACs.
IPOs.
Was that SPAC
And we had
City?
SPACs as well.
Chamath and all that.
Yeah, we should probably hit the button for that. But those were basically blank check companies.
Go
So
on.
you have a company
Oh,
on
we
the stock
can't, it's
market.
too far.
It's too far. Your turn.
Oh,
There you go.
Second time lucky. But yeah, a SPAC, basically, a company already on the stock market, millions of dollars, can basically buy another company to get them onto the stock market rather than that company who they bought directly listing onto the stock market.
so they create these shell companies.
You basically have a shell
special purpose
company,
acquisition
yeah.
company. Then they get everyone to buy in for like a tenner,
Yeah.
and then they use that money to go and buy a business to get it on, backdoor
Yeah.
it onto the stock market. I heard Chamath talking about him again the other day. He was
Yeah.
like, they're one of the best vehicles. I was like, here he goes. We've reached the top, guys.
Yeah.
Chamath's
And-
talking
and
about
again,
SPACs.
these are all things which in hindsight we could have looked back on and thought, okay, maybe we're reaching the top. But at the moment, we're not yet. It's difficult. It's a very difficult time though, and that's why. And it was funny. I was thinking of another phrase which a very popular investor a long time ago was quoted by saying, "It's tempting as a bullish investor to fall into this trap of saying this time it's different." The dangerous 4 words to justify why everything should keep going up. But I think this time it's always different, which makes it so hard.
Yeah, well, I think
It's always different.
for anyone that's like our age, right? So mid to late 30s, I would just say that you've seen in your life the dot-com bubble, the global crisis, a pandemic. You've seen some crazy stuff, and here we are at an all-time high.
Yeah.
So what's next? Who knows, right? But it's either going to be the end of the world, or
Yeah.
we're all just going to have to shake it off and crack on.
Yeah, and if
So,
it's the end of the world, we won't be worried about
either
how
way,
much our
yeah,
investments are worth
that's
anyway.
what I mean. That's what I mean.
Yeah.
So, people will be fighting over cat food and gold, if you
Yeah.
believe the gold bugs. But yeah, I just think we've been through quite a lot, haven't we? And here we are at all-time highs.
Yeah, for sure. It's just a good reminder that in the short term, all of these things really should have no impact on what you do as a long-term investor. But it's all easier said than done. You just got to really focus on what matters. Focus on your job, like you were saying. 99.99% of people, our job is going to be our income. If you want income, get a better job. Investing is not for income today. Later on, much later on in life, if you want to retire early or pull money out, then you can maybe start having that conversation about what your investments can pay you. But for the time being, trying to waste your time on stock market picks and wasting your time trying to predict the market, I think
This is a really good point, because what people are doing by asking, is the market about to drop, is they're basically turning the stock market into a money for today question, not a money for tomorrow.
Yeah.
If it's a money for tomorrow question, well, then you want it to drop today so they can buy more units
Yeah.
at a cheaper price. And if you just focus on earning as much and going about your day and then putting it into the market, and what the market's there to actually do is to turn the results of your labor into long-term support for you when you have no labor left. And what you're really doing is outrunning inflation.
100%, yeah. I always try and bring it back because investing can be quite an abstract topic, and we forget that when you actually do invest, at least in the stock market, in real companies, you're basically getting a really small slice of everyone's labor. So everyone leaves their house and wakes up in the morning and goes to work and makes a very tiny bit of money for you. That's a nicer way to look at it. Every NVIDIA graphics card that gets sold, every Apple iPhone that gets bought, basically you are entitled to a tiny, tiny, tiny fraction of those profits. And I think we'd probably have a bit of a better world if more of us were engaged in that, and we could all benefit from those rise in good companies.
The reason anyone with a company hires people is because it gives them scale. It gives them ownership of that person's labor, which allows them to grow that business bigger than their individual effort. Yeah. So by buying the stock market, you buy the labor of the world.
Yeah.
And I think that's it. Everyone becomes your employee.
Yeah.
And it's like, unless we all get nuked into oblivion, is there ever going to be a day where everyone doesn't get up and go to work? Like, you might believe that.
Who knows? I mean, our robot overlords could come and do everything for us, but then
bring it on, mate. That sounds glorious.
Yeah, that sounds good.
So cool with the robots, man.
Why
When Terminator comes,
cool?
you're just trying to be pally with them. Like, it's not cool.
Yeah,
just be good with
our jobs.
Put the guns down.
Mate, I just, like the way I see it is, I'm when I had a cat, I was pretty nice to him. So if I'm like a robot cat, like cat to a robot, they're so insignificant. They're like, oh, look at my cute little pet. Just getting pet and getting nice food, get strokes.
So now I'm picturing
chill by the fire. Nice.
I'm picturing the robot now patting Damien.
Literally, there's a good day, man.
You've done well today at your little job.
Yeah, bring on the robots, mate. There's a long way between them Skynet going live, surely, and where we're at.
Not even before Skynet, though, like the jobs. Because if they're taking lots of people's jobs, I'm just worried that like a lot of AI will take loads of jobs.
The washing
machines will take loads of jobs.
The washing machine took loads of people's jobs.
Well, right now we're filming this in the
task.
heart of Manchester, basically where the Industrial Revolution started. All these canals which used to bring raw cotton to all the different factories, just literally moments away. Now, what's funny is the first machines in these factories, people would smash them up because they were fearful that
the Luddites.
Yeah, the machines would take people's jobs. Now, what machines in effect? What really happened was they freed up people's jobs they freed up their labor to do other jobs. Rather than having one factory, you can now have 10 factories. Now, the conditions in those factories were not very nice. So this is not a a commendation of what happened during that time, but it boomed because basically we created really machines and robots to do these jobs. AI is going to be such an interesting one because is it going to be like that where basically it frees up people's labor to do other good stuff? So like Damien said, washing machines. We already have robots in our houses. Washing machines, dryers, fridges. They're not humanoid robots, but they're basically machines which do labor, which used to take up most of people's times. I mean, in certain countries in the world, still, washing is taking up hours and hours of people's time. So right now, we free up our time with machines. In the future, how much of our time is going to be freed up there?
But we also free up jobs with machines. Sainsbury's, they've got all these self-service checkout. That used to be someone's job.
Yeah, but mate,
they would hire like 10 people, now they hire 2 people.
Correct.
When I got my job taken away from me due to COVID and furlough, I started this YouTube channel. Like, someone freed up my labor and I sat there, I got drunk for 2 weeks and played Skyrim, great game. And then I went, I best do something with my time. And I started a YouTube channel, and every single YouTuber I know started basically in 2020. There's a few that were before it, but all of the like financy ones, it's like, 2020-ish, 2021, because we had a bit of free time. You most people, if you like, you put them, you free them from this like, do that job, they will find stuff to do. I do think we need to think about it carefully from like
the dream would be like rubbish manual jobs, which really people don't want to do. If that could all be freed up to us, we can do the better jobs, I guess, the more service jobs, the less manual jobs. That would be the dream. But however, I think we could be onto something that even the middle layer jobs could also be done by AI. Exactly. Then what do we leave after that? I mean, then we go into this future
I would argue that like a manual job is more important than a lot of the middle managers I ever had when I was
they're
around.
really important for sure. They're really important. And also, I don't think it's that easy. If you think about, just having the amount of tradespeople I've had around my house at the moment, no robot on the planet right now can do plumbing, can do electrics to any level
of building
dexterity.
And construction, though.
They can do some level of that.
Paint a wall.
They can do
100
some level.
times quicker than we can paint a wall.
But it's better that the human with the sprayer is better than the robot with the sprayer, at least at the moment. Anyway, at some point, if we do have the robots, maybe I'll come back on and we'll have a different discussion.
We should talk about job. I think on the other side of it, it's like, what's the job creation? Because every technology that's destroyed jobs has created them on the other side. The problem is, how painful is that transition? Yeah. Like what that's what we're worried about. We don't want people to billions of people to lose their income.
No, that's the thing. I think an economy would be rubbish if millions of people were unemployed. That would be a rubbish economy. It wouldn't actually benefit anyone because then you'd have so many people unemployed, loads more people would need benefits. So actually we need like more employment. So I'm definitely interested in where it goes. I'm less cynical about where everyone's going to get their job taken.
I'm quite optimistic. I used to watch Tomorrow's World when I was a kid.
Yeah.
And I used to buzz off that show. They'd be like, one day you'll have a computer in your hand. And I'd be like, what? And I'm living in the future.
It's funny.
I'm living in the future.
So I get offered that on my YouTube. I was watching that from the BBC archive, and they didn't go far enough. So they would say, oh, you're going to get a computer in your hand, like you said, like a watch. But all they thought it might be able to do is type in some basic stuff, or, oh, you got a computer with a printer in a briefcase. Imagine that. They didn't go far enough because they couldn't even imagine what's possible.
Now you don't need to print anything.
No, you don't need to do. Yeah,
you still can't print anything.
Printing.
Ever tried printing anything? Bloody hell.
Yeah.
HP and absolute racket. Robots should replace them guys.
Yeah.
I hate them. You can print 3 sheets and it's like, you need new ink. Like, what's just going on? I just got the ink. It costs more than the printer. Anyway, should we get back to bubbles?
Get back to bubbles.
You got a question?
Why is it that whenever the stock market gets record highs or crypto, anything, why do people always act so emotional and why is it that people don't know how to act? Because we invest we want that result. So when it happens, everyone's like, what do I do now? Do I sell? Like, is a dip coming? Like, why are we like that?
I think you need to get a psychologist on, but from the stuff that I read and some of the interesting stuff and some of the interesting work by like Daniel Kahneman, it's all that poor human psychology, unfortunately, that we have a loss aversion bias. So we're basically more biased to fear and scary things. That's why our headlines are scary, basically, and we're attracted to those things. It's why we're afraid of a loss twice as much as we are of a gain, for example. And but basically, it comes down to emotions, like you said. So we're just afraid of losing, basically. You know, so
it's like a resource thing, isn't it?
It's a resource.
If
yeah,
you were
but
like
it's good.
a caveman or whatever, and you had you found a bush with some berries on it, and you were like, I should probably take all these now because I don't know if they're going to be here tomorrow. Whereas what investment is this sacrifice of today for tomorrow, which is complete odds with what we're designed to do.
It's against human psychology in a way, because it's so we're not wired to think decades ahead. We're barely wired to think a week ahead. You know, didn't help us survive. We wanted to go day-to-day survival. Have I got my food? Have I got my water? Have I got my shelter? And I'm okay. And now, look what's happened to us. So yeah, it's going to keep coming around. And it's funny, even though we've got all of this 100 years of data, we can look back on stock market investing and what you should do. People are still going to fall into the same traps, I think. And it's really interesting. I think we're going to repeat the same mistakes. Our memories are just so short. And I think the way I could compare this to anything like eating well and working out at the gym, all these things, you think that most people already know these things. Oh, you should, eat less calories than you consume, or whatever, burn, and you'll lose weight. Or you should eat, a healthy, balanced diet, and you'll probably be okay. And or progressive overload at the gym, and again, you'll probably build muscle. Most people, you think, know these things. Doesn't mean they'll do them.
But it's like the gym, I always say, is the perfect analogy for the stock market, because imagine you've been going to the gym for 10 years, it worked, you're looking swollen, you're like, right, I'll stop going to the gym now just in case it disappears. It's like that kind of logic, isn't it? It's like, oh, I'll stop doing that, the thing that works.
It's worked so well.
Because it has worked, we've got the results. And then, there's no one workout that you will ever do that is the workout that you go, that's the one that made me fit. It's the consistency of habit over decades that basically get you to where you want to be.
You know what, it's funny, actually, on that analogy, we can even make that better. One person at the gym might think, wow, just the bicep curl has made me really strong. Therefore, that must be the thing to do. And that's like stock market investing, saying, oh, every time this chart goes to this level, I better buy it. And it's worked out well for me so far. And they'll attribute that to that one thing, even though it has nothing to do with it.
Yeah, people who are into fitness are the perfect for long-term investing because they have the exact mindset of long-term sacrifice and commitment, doing the boring stuff, consistency. Yeah, I say that to my PT all the time because he's like, should I buy this company? I'm like, no, mate. Like, and I said to him, should I go over there and lift like 200 kilograms on the squat? He's like, no, that's stupid.
Obvious,
I'm like, well, there you go.
Yeah,
like,
that's pretty much the same answer.
Yeah. I think one comment we'll probably get is not just the impending, oh, will it crash? It's more, I've got a pot of money now. Yeah. Should I stick it all in the market, or should I wait, or should I drip feed it?
Yeah.
And what would you say to that person?
I get this all the time. This must pop up at least like 3 times a week on my channel. And it comes down to the same thing. So generally speaking, if we look at all the statistics and all the data we have in the stock market, it's almost always, which sounds like something out of a film, almost always a good time to put everything you have in the market that you're comfortable investing with, comfortable sticking away for a long time right now. However, most people, I think, really need to decide for themselves of what level of risk they're happy with. And goes back to that test you mentioned as well, about if you can sleep at night, I think you should then potentially think about, if you've got a big sum of money now, maybe you should invest it a bit every week, a bit every month, a bit every couple of months. It's truly up to you. But generally speaking, lump summing it in now would be the best thing to do. And actually, if you are an investor who invests every month into your pension from your workplace, technically you are a lump sum investor because you are putting in money that you have right now.
Yeah, it's a head and a heart thing.
It is always
because the market tends to go up more than it goes down. It makes sense to put all your money in straight away to get that long-term ride.
Yeah.
But if the market drops tomorrow, you were unlucky.
Yeah.
If you're the kind of person that would hate that so much, well, then break it up into chunks and just deploy it over time, because that's the heart element.
It's got to be for that, yeah. And actually, there's some interesting data that says since 1950 in the S&P 500, if you would have invested at just all-time highs, you basically make nearly as much money as a lump sum investor would have if they just invested from day one. So if you literally just invested at all-time highs, you still nearly make as much money.
Yeah. One thing actually I wanted to talk about then was there's a lot more chat nowadays around how indexes and the wall of money that flows into markets might actually be a bad thing.
Yeah.
How much do valuations do you think could be this just passive approach? People like me and you basically just peddling this mantra.
Every month we're buy.
Yeah,
and at some point, because at some point everyone can't just do this. Because if everyone just did the same thing, basically we'd all get the same returns, or the returns would be removed from the stock market. So everyone can't do just passive investing, right? So we do need a healthy, active market out there. So I think the latest stats, I think passive investing is still just over half, or a bit more over half of all investing at the moment. The true active investing, I think, is only a very small fraction. But let's just look at the market at the moment. So recently, the news that with OpenAI investing into, or AMD, or the other way around, AMD share price went up about 30% in a couple of hours, in a day. So the active market at the moment is very healthy, I would argue. And I did a video on this one again a while back saying, okay, what if we were in a world where everyone was passive and there was no active market because we've told everyone how bad active stock picking is? Well, in the way I would see it, if everyone was just passive and we just kept pumping money into the same companies, the big ones, then surely the few active stock pickers that were left would have an absolute field day, right? Because there would be, the pricing would be wrong in a lot of these companies. They would go, there's no way you can value this company at $15 trillion. It should be worth, it's only bringing in 500 billion, for example. So, and then what that would do is really, it's the incentive structure again. People investing passively would go, hey, I'm only making 1% a year, but this active guy over there is making 20%. Their money would start going into active. So active and passive is just going to keep fighting each other. And I think it's always going to balance each other out at some stage. I don't know what the right percentage is, but for the ones who because there's so much reward potential for active investors, there's always going to be people active investing. But I like the fact that passive investing is growing, because active investors, as most of you will know, has still shown itself to be pretty poor. Even before and after their fees, most of the time, a vast majority of them fail to beat the returns of the market average in the short term, and especially in the long term. Yes, there are a few who make an absolute killing, and there are a few who make a killing by following them, going with them. But generally speaking, you do need a healthy active market. So it's a really difficult one, because although the vast majority of average people should probably just stick to passive investing, we do need a healthy active market. So in a way, we need people to be naive, ambitious, to risk it, basically, to go for it. So it's a bit of a weird narrative to talk about. So maybe should we all have a little bit of an active side to us as well when we invest?
But then it's like, maybe the active guys actually need to know what they're doing. It's like, what type of active?
Yeah.
Because, everyone just buying their favorite stunk is probably not the kind of price discovery we're looking for. We're looking for people that are valuing businesses and going, oh no, and yes. And
for sure, yeah. But I would also say they can buy it for whatever reason they want. They can buy it because they woke up and they felt good that day. It doesn't, almost don't care, but we do need a good, healthy market out there. We also, lots of people forget, every time you buy the market, even if you buy your ETF or a mutual fund, someone else is selling you shares. So there is a market there. For every one of us out here buying, there's plenty of retirees drawing down on their investment funds as well. So there's always a healthy market.
Yeah, and
we
it's
have
a big
to remember
negative drag that, especially with an aging population. There's
Yeah.
going to be a massive cohort of decumulators that are going to be selling
Yeah, there's always
broad
lots of
DB
sellers.
schemes and their own private assets.
Yeah. You could argue that could even be a bearish thing. You could say, wow, that more people are going to be selling in the next few decades.
It's going to crash. Get
buying.
out.
Could be a crash. But then you could also say then there might be more people inheriting enormous sums of money that they never inherited before. So therefore, there's more wealth than there's ever been before. What are they going to do with it?
So is it overvalued, Toby? What's the answer?
I would say it's basically it's an impossible question to ask, and I think if you're asking the question, I think you're asking the wrong question. Because what you're really saying, like you said earlier, was basically you're trying to time the market. If you're asking that question, you're worried about losing money. Now, I would say if you're a long-term investor and you're going to invest regularly every single month, it's not a question you should ever worry about. I think it's really interesting to look at all the data, but no data from the past can ever tell you if the stock market is going to be overvalued unless you knew the future. Because, for example, the future could have more returns than we can ever even realize. And it could be justified. But until we know that, we can't ever know truly. And the best guess at any time, whether the market is overvalued or the right price, is just the market at this price right now. Every stock on the stock market right now is priced at the moment because this is what all the buyers and sellers basically have agreed right now. If you want to disagree with that, you're very, very welcome to do that. But those who do tend to disagree with those and buy things on their own whim as an active investor do tend to lose. Generally, but there's always winners.
And I would add to that, if you're every night asking yourself, is the market overvalued? Maybe the action that you take is to consider the percentage allocation that you have.
Sure, exactly.
Because you might be overexposed to the market. If you're losing sleep because you're 100% equities and you think it's going to drop, and if it did drop, it would ruin your life.
100%.
Maybe you need to rebalance and de-risk.
Exactly.
For me, I'm like 100% equities. If it drops, bring it on.
Yeah.
Where's the robots at?
Yeah, but you're right. Yeah, bring on
Sex
the
robots.
robot.
That's right. I want that sex robot, mate.
They're like, good day, but
Yeah, good day.
you've been a good YouTuber today. And you're like, thank you. Yeah, that's what you want.
Yeah. Call me Daddy Pig.
Well, welcome to Late Night Money. We're gonna dim the lights now and turn this over. Did you like the podcast?
I think it was a great episode. Hopefully got people to, calm down a little bit, not panic thinking that the crash is about to happen. It might be able to happen. We don't know the future. But I think we should all be looking at, well, not all of us, but we should be looking at the long investment horizon was the most important thing.
Yeah.
If you're investing long term, don't get emotional with all these things.
I'm feeling slightly panicked and unnerved by you standing behind us. It's like a hostage situation. I'm also slightly worried about my admission around sex robots. But we love robots here. So actually we've developed an AI. That segue, mate. So smooth.
That was smooth. That was smooth.
So we know the challenges that AI present. We know that they can hallucinate and we know that they can be a bit rubbish at times, but we also know that they can be excellent. And you can ask an AI your personal finance questions without judgment. So we've developed one of our own. We'll link it below. We're looking for some people to test it, try and break it, see if there's any weird quirks that come out of this, just to see if we've made something good and we're onto something. But yeah, send help, Toby. Send help. Send help.
I went into the robot.
You did a robot.
Yeah, that was quality. Literally, when you were like, send help, and he was like...